Warren Buffett is a legendary example of how mastering financial statements alone can empower world-class investment decisions. Buffett is known for making multi-billion-dollar investments in companies, sometimes without visiting their headquarters, meeting the management, or commissioning deep strategic due diligence. His reasoning? The numbers tell the story. He believes that a company's financial statements reveal more than any sales pitch, glossy presentation, or CEO interview. Here's how. Income statement, durable profitability, consistent revenue growth over several years, high and stable profit margins, strong net income even during downturns, balance sheet financial strength, low debt levels relative to equity, strong asset base, especially cash and receivables, owner's equity growth year over year, cash flow statement, real cash, not accounting tricks, free cash flow, FCF, as a sign of value generation, operating cash flow matching or exceeding net income, avoidance of companies with negative or volatile cash flows. In 1988, Buffett invested over $1 billion in Coca-Cola, mainly by analyzing their financials. What he saw: massive global reach and pricing power, visible in income growth, little debt and high returns on equity, balance sheet, predictable and growing free cash flow. Lesson for learners: if you can read financial statements, you can speak the language of business and make smarter investment decisions than most people ever will. Financial statements are the foundation of fundamental analysis. They offer a structured summary of a company's financial performance and position. Investors, analysts, and other stakeholders rely on them to assess the health and profitability of a business. There are three main financial statements every investor should understand: the income statement, the balance sheet, the cash flow statement. The income statement shows a company's revenues and expenses over a specific period. It reveals whether a business is profitable. Key components: revenue or sales, the top line showing total earnings from operations. Cost of goods sold, COGS, direct costs of producing goods, services. Gross profit, revenue minus COGS. Operating expenses, costs related to running the business, for example, salaries, rent. Operating profit, EBIT, earnings before interest and taxes. Net profit, the bottom line, what remains after all expenses and taxes. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It follows the equation: assets = liabilities plus shareholders' equity. Key sections: assets, what the company owns, for example, cash, inventory, property. Liabilities, what the company owes, for example, loans, accounts payable. Shareholders' equity, owner's residual interest after liabilities are subtracted from assets. This statement tracks the flow of cash in and out of a company. It helps determine the firm's liquidity and cash generating capacity. Divided into three parts: cash flow from operating activities, cash generated by core business; cash flow from investing activities, cash used for or generated from investments in assets; cash flow from financing activities, cash from issuing, repaying debt or equity. By mastering financial statements, investors can identify profitable versus unprofitable businesses, assess debt levels and cash flow health, compare companies across sectors, detect potential red flags, for example, inconsistent cash flow, rising debt. Fundamental analysis starts with reading and interpreting these statements correctly. They are the building blocks for valuation, forecasting, and investment decision-making.